Welcome to my dear students. I am Mr. Ganeshan K, Assistant Professor of Commerce, subject Corporate Accounting, topic Profit prior to incorporation. In the previous sessions, we have discussed problems of profit prior to incorporation. Even in this session, I am going to discuss problems of profit prior to incorporation. RKS Limited was incorporated on 1/9/2012 to take over the running business of Messrs. SK and Company with effect from 1/4/2012. The company closed its books of accounts on 31/3/2013. Following are the incomes and expenses of RKS Limited for the year ending 31st March 2013. Particulars amount, gross profit 24 lakhs, discounted 1,14,000, interest on investments 1,20,000, salary and wages 3,60,000, discount allowed 2,16,000, preliminary expenses 10,000, general expenses 24,000, carriage outward 5,400, bad debts 3,600, interest to vendors up to 31/1/2013 60,000, rent paid 96,000, selling expenses 54,000, directors fees 30,000, auditors fees 24,000, depreciation 1,44,000, insurance 12,000, carriage inward 2,280, interest on debentures 24,000. Then we are having additional information. So, number one, average monthly purchases during the pre-incorporation period was rupees 1,50,000 and the average monthly purchases of post-incorporation period was 3 lakh. Average monthly sales during the pre-incorporation period was rupees 2 lakh and the average monthly sales of post-incorporation period was rupees 5 lakh. Prepare a statement showing profit or loss between pre- and post-incorporation period. My dear students, now in the first instance, we have to calculate time ratio. So, number of months from the date of purchase to the date of incorporation. Please go to the problem, my dear students. RKS Limited was incorporated on 1/9/2012 to take over the running business of Messrs. SK and Company with effect from 1/4/2012. It means that the business was acquired on 1/4/2012 and it was incorporated on 1/9/2012. From 1/4/2012 to 1/9/2012, it will be for a span of 5 months, and from 1/9/2012 to 31st March 2013, it will be for a span of 7 months. Therefore, time ratio will be 5:7. Okay. Next, let us calculate sales ratio. Right? So, while calculating sales ratio, we must consider sales during pre-incorporation period and sales during post-incorporation period. So, average sales during pre-incorporation period was 2 lakh and average monthly sales during post-incorporation period was 5 lakh. So, during pre-incorporation period, it is 2 lakh. During post-incorporation period, it is 5 lakh. Pre-incorporation period in terms of months 5 months, post-incorporation period in terms of months 7 months, 2 lakh into 5 10 lakh, 5 lakh into 7 35 lakhs. Therefore, sales ratio will be, I can say, 2:7. 5 2s are 10, 5 7s are 35. Next, we are calculating purchase ratio. See, now the question arises, why we need purchase ratio? So, purchase ratio is needed for the purpose of apportioning discount earned. My dear students, we know very well there are two things here. One is discount allowed and second one is discount earned. Discount earned is apportioned based on purchase ratio. Discount allowed is apportioned based on sales ratio. Since there is discount earned in this problem, therefore we are supposed to calculate purchase ratio. Now, please go through the problems, my dear students. Now, average monthly purchases during the pre-incorporation period was rupees 1,50,000 and the average monthly purchases of post-incorporation period was rupees 3 lakh. Now, So pre-incorporation purchases 1,50,000, post-incorporation purchases 3 lakh. So 1,50,000 into 5, 3 lakh into 7, 1,50,000 into 5, 7,50,000, 3 lakh into 7, 21 lakh. Therefore, your purchase ratio will be, after simplifying, 75 is to 210. So if you simplify once again, it comes to 15 is to 42. Now, let us concentrate on the items that has been specified in our problem. Accordingly, we are having gross profit, then discounted, then interest on investment, then salary and wages, then depreciation, then interest on debentures, then interest to vendors, then discount allowed, preliminary expenses, general expenses, carriage outward, bad debts, then rent paid, then selling expenses, then director's fees, then auditor's fees, then insurance. Now, my dear students, let me be very slow. Gross profit sales ratio, discounted purchase ratio, interest on investments time ratio, salary and wages time ratio, discount allowed sales ratio, preliminary expenses written off post incorporation, general expenses time ratio, carriage outward sales ratio, bad debts sales ratio, interest to vendors revised time ratio, rent paid time ratio, selling expenses sales ratio, director's fees post incorporation, auditor's fees post incorporation, depreciation time ratio, insurance time ratio, carriage inward purchase ratio, interest on debentures post incorporation. Now, with this, let me solve this interest on debentures once again post incorporation. Okay, now let me substitute the values here. Okay, gross profit given in the problem 24 lakhs, sales ratio 2 is to 7. So 24 lakhs into 2 by 9, 5 lakh 33,333. 24 lakhs into 7 by 9, 18 lakhs 66,667. In other income part, we come across two things. One is discounted, second one is interest on investment. Discounted purchase ratio. What's the discount here? 1,14,000. 1,14,000 into 15 by 57. How we got 57? 15 plus 42. Then 1,14,000 into 42 by 57. We are getting 30,000, 84,000. Interest on investments, we have 1,20,000. 1,20,000 into 5 by 12, 50,000, 70,000. So this will be the part of your part. I can say the first part. First part means I can say about total revenue. Total revenue is concerned, we are having revenue from operation. Second one, other incomes. Now let us focus on the various expenses. Now let us focus on the various what expenses. Accordingly, we are having employee benefit what expenses. Under employee benefit expenses, okay, we consider salary and wages. Salary and wages will be apportioned based on time ratio. Time ratio is 5 to 7. In total, we are having 3,60,000. If you apportion between pre-incorporation and post-incorporation period, it will be 1,50,000, 2,10,000. Then depreciation, once again time ratio, we are having 1,44,000. 1,44,000 into 5 by 12, 60,000. 1,44,000 into 7 by 12, 84,000. And then we are having what? Finance cost. So in the finance cost, we come across interest on debentures. So interest on debentures should be a portion purely for post incorporation. Then interest to vendors based on what revised time ratio, which is 1:1. We are having 60,000, 30,000, 30,000. And then we come across other expenses, discount allowed. Okay, discount allowed will be a portion based on sales ratio. Sales ratio is 2:7. 2,16,000 into 2 by 9, 48,000, 1,68,000. Preliminary expenses, post incorporation 10,000. General expenses, time ratio 5:7. Total we are having what? 24,000. 24,000 into 5 by 12. 24,000 to 5 by 12, 10,000. 24,000 to 7 by 12, 14,000. Carry out that sales ratio 2:7. 5,400 into 2 by 9. 5,400 into 7 by 9. Brackets, sales ratio 3,600 2 by 9. 3,600 into 7 by 9. We are getting what? 800, 2800. Rate paid, time ratio 5:7, 96,000. 96,000 into 5 by 12. 96,000 into 7 by 12. Then we are having what? Selling expenses, sales ratio 2:7. 54,000 into 2 by 9. 54,000 into 7 by 9. And we are having directors fees, post incorporation 30,000. Orders fees, post incorporation 24,000. Insurance, time ratio 5:7. So accordingly we are having 12,000, 5,000, 7,000. Now, this will be substituted. Okay. Now, revenue from operation 5,23,000, 3,23,000. Other incomes 80,000. Total revenue, total we are getting 6,13,333. Okay, 6,13,333 for pre-incorporation. For post-incorporation, we are getting what? 20,20,667. Then the expenses are concerned. Cost of material consumed nil. Employee benefit expenses, we are having 1,50,000 for pre-incorporation, 2,10,000 for post-incorporation. Depreciation and amortization, 60,000 for pre-incorporation and 84,000 for post-incorporation. Finance cost 30,000 for pre-incorporation, 54,000 for post-incorporation. Other expenses 1,17,000 for pre-incorporation, 3,58,000 for post-incorporation. Total expenses 3,57,000, then 7,06,000, 3,57,000 for pre-incorporation, 7,06,000 for post-incorporation. So total revenue minus total expenses 6,13,333 minus 3,57,000, 2,56,333. It will be pre-incorporation profit which will be transferred to capital reserve. Then 20,20,667 minus 7,06,000, 13,14,667. This will be your what? Post-incorporation profit which will be transferred to profit and loss account. So this is about this problem. Okay, we are going to discuss few more problems in the coming session. Thank you.